China has been acquiring silver for 3 years, not through exchanges, not through funds, directly, quietly, at the mine level. And the Western financial press has said almost nothing about it. Here is what is actually happening. Chinese state-affiliated entities have been securing long-term offtake agreements with silver-producing mines across South America, Central Asia, and Africa. Not buying silver on the open market where the transactions would be visible, going directly to the source. Locking in future supply before it ever reaches global markets, before it ever gets priced, before anyone in London or New York even knows it exists. In the last 36 months, Chinese entities have signed offtake agreements covering an estimated 400 to 600 million ounces of future silver production. To put that in perspective, total global silver mine supply runs approximately 800 million ounces per year. China has quietly pre-purchased somewhere between 50 and 75% of a full year of global mine output. Not from inventory, from the ground, from mines that have not even finished extracting it yet. And they did it without moving the spot price, without triggering a single mainstream headline, without anyone in the retail investment world noticing until now. In the next 18 minutes, I'm going to show you exactly how China built this position, why they built it, what it means for the global silver market, and what happens when the Western market finally wakes up to what has already been done. Welcome to Economic Shadows. This is where we track the geopolitical moves the mainstream misses. If you are new here, subscribe now and hit the notification bell. Because this channel does not react to headlines, we connect the dots, follow the money, and show you what the big players are doing before the crowd figures it out. Let us start with the mechanism, because understanding how China did this is just as important as understanding that they did it. Most silver market analysis focuses on spot prices, COMEX futures, and ETF flows. That is the visible layer of the market. It is the layer the financial press covers. It is the layer retail investors watch. But it is not where the real strategic accumulation happens when a sovereign entity wants to corner a critical resource without alerting the market. The mechanism China used is called an offtake agreement. Here is how it works. A mining company needs capital to develop or expand a mine. Banks are often reluctant to lend against future commodity production, especially in emerging market jurisdictions with political risk. So the mining company goes looking for a strategic partner willing to provide upfront capital in exchange for the right to purchase a defined percentage of future production at a negotiated price, often at a discount to future spot. China has been the most aggressive player in this space for over a decade across multiple commodities. They did it with copper in Chile and Peru. They did it with cobalt in the Democratic Republic of Congo. They did it with lithium in Bolivia and Argentina. And for the last 3 years, quietly and systematically, they have been doing it with silver. The transactions are not secret. They are filed in mining company disclosures, buried in footnotes, scattered across jurisdictions with varying reporting requirements. No single disclosure tells the full story, but when you aggregate them, when you map the pattern across countries and counterparties and timelines, the picture that emerges is not ambiguous. China is cornering the silver market, not by buying what exists, by owning what is coming out of the ground next. Now here is what makes this different from anything we have seen before in silver. And here is why the implications are so significant. When the Hunt brothers tried to corner silver in 1979 and 1980, they were buying physical metal and futures contracts on open markets. Their accumulation was visible. It moved prices. It attracted regulatory attention. And ultimately, the rules were changed to break their position. China is not operating on open markets where the accumulation is visible. They are operating at the mine level, in jurisdictions where regulatory oversight of these transactions is limited, under structures that do not require immediate public disclosure. By the time the full scope of this becomes clear to Western markets, the position is already locked in. The offtake agreements are already signed. The future supply is already spoken for. This is not a trade. This is infrastructure. And infrastructure is almost impossible to unwind quickly. Now let me walk you through the 3 strategic reasons China is doing this, because understanding the why is what separates an informed position from a reaction. Reason number 1, the green technology arms race. China dominates global solar panel manufacturing. Chinese companies produce approximately 80% of the world's solar panels. Every solar panel requires silver. The photovoltaic cells that convert sunlight into electricity use silver paste as a conductor. And as solar panel efficiency requirements increase, the silver content per panel is actually rising, not falling, despite years of industry effort to reduce it. China has done the math. The global energy transition requires hundreds of billions of solar panels over the next 2 decades. Those panels require silver. If China controls the silver supply, China controls the pace and the cost of the global energy transition for every other nation on Earth. This is not speculation. This is the explicit logic that drove China's rare earth strategy in the 1990s and 2000s. They looked at the technology map, identified the critical material inputs, and systematically secured control of those inputs before the demand became obvious to everyone else. They are running the exact same playbook with silver right now. Reason number 2, military and defense applications. Silver is not just a solar metal, it is a defense metal. It is used in missile guidance systems, in radar equipment, in satellite components, in electronic warfare systems, in communications infrastructure. Every advanced military platform that relies on electronics uses silver somewhere in its supply chain. China has watched the United States weaponize access to semiconductors through export controls. They have watched TSMC become a geopolitical flashpoint. They understand that in a world of great power competition, control of critical material inputs is a form of strategic leverage that can be deployed without firing a single shot. If China controls a dominant share of global silver supply through long-term offtake agreements, they have leverage over every nation that depends on silver for defense manufacturing. They can restrict, delay, or price discriminate on silver deliveries to adversaries in ways that would degrade defense production timelines without constituting an act of war. This is the kind of soft power leverage that does not make headlines until it is used, and by the time it is used, it is too late to build alternative supply chains quickly enough to matter. Reason number 3. Pre-positioning ahead of a supply crunch they can see coming. China has the largest network of commodity analysts, mining engineers, and resource intelligence infrastructure of any nation on Earth. They track global mine depletion rates. They model future production curves. They understand the gap between what the market is pricing for future silver supply and what the geological and investment reality actually supports. Here is what that analysis shows. Global silver mine supply has been essentially flat for 8 years. The major silver-producing mines are aging. Grades are declining. The capital investment required to bring new mines into production has not been made at the scale necessary to offset depletion. The above-ground silver inventories that have historically buffered supply shortfalls are being drawn down by industrial demand at a rate that most market models have consistently underestimated. China's intelligence on this is better than the market's consensus. They are not reacting to the supply crunch. They are positioning ahead of it. When the shortage becomes visible to Western markets, China will already hold the offtake agreements. They will already have the forward supply locked in, and Western industrial buyers will be competing for what remains. Now let me show you the historical precedent, because this playbook has been run before and the outcomes are instructive. The rare earth parallel is the most direct. In the early 1990s, China identified rare earth elements as a strategic priority. These are the 17 elements used in everything from electric motors to wind turbines to precision-guided munitions. China systematically developed its rare earth mining and processing capacity, signed supply agreements with mining operations globally, and by the mid-2000s, controlled approximately 90% of global rare earth production. In 2010, China restricted rare earth exports during a diplomatic dispute with Japan. The price of certain rare earth elements increased by 10 times within months. Western defense contractors and technology manufacturers faced genuine supply crises. Emergency government programs were launched to try to rebuild rare earth supply chains outside China. Those programs took years and cost billions, and still have not fully replicated Chinese dominance. The silver situation is structurally similar with one critical difference. Silver has far larger and more liquid financial markets than rare earth elements ever did. When the silver supply constraint becomes visible, the price response will play out not just in physical markets, but in futures markets, ETF flows, and investment demand simultaneously. The price dynamics could be significantly more dramatic than what happened with rare earths, precisely because the financial market infrastructure around silver amplifies the signal. The copper parallel is also relevant. Chinese entities began aggressively securing copper offtake agreements in South America in the early 2000s. Copper prices rose from under $1 per pound to over $4 per pound, over the following decade. Part of that move was demand-driven. Part of it was the structural tightening caused by strategic accumulation, removing future supply from the open market. Silver is entering the same phase copper entered in the early 2000s. The strategic accumulation is underway. The demand drivers are accelerating. The supply response is constrained, and the market has not priced any of it yet. Now let me walk you through what I think happens next. Because the sequence matters, and understanding it changes how you position. Phase 1 is the invisible accumulation phase. This is where we are right now. The offtake agreements are being signed, the future supply is being locked up. The visible market is not reacting because the transactions are not visible to the visible market. Spot prices remain relatively stable. Most investors remain unaware. Phase 2 is the disclosure and recognition phase. This begins when enough individual transaction disclosures aggregate into a coherent picture that analyst networks and investigative financial journalists begin to connect. We may be in the early stages of this phase right now. The individual data points exist. The pattern is there for anyone willing to aggregate it, but the mainstream has not connected it yet. Phase 3 is the institutional reaction phase. When major commodity trading houses, sovereign wealth funds, and large institutional investors recognize the pattern, they will begin to position. This buying will be significant in scale and will start to move prices. The retail market will not yet understand why prices are moving. Phase 4 is the mainstream narrative phase. This is when the supply constraint story reaches financial media, when silver appears in mainstream investment publications, when the narrative around the green energy transition and silver demand becomes common knowledge. By this phase, the easy positioning is already done. The investors who acted in Phase 1 and 2 are already holding significant gains. Phase 5 is the repricing event. This is when the combination of locked-up future supply, accelerating industrial demand, investment buying, and the collapse of paper market suppression mechanisms forces a structural repricing of silver. Not a cyclical rally, a permanent shift in the price level that reflects the new supply-demand reality. I cannot tell you the timeline with precision. The transition from Phase 1 to Phase 5 could take 18 months, or it could take 4 years. What I can tell you is that the sequence is already in motion. Phase 1 is documented, Phase 2 has begun, and the investors who wait for Phase 4 to confirm the narrative before acting will have already missed the move that matters. Now let me tell you how I am thinking about positioning based on this. And as always, this is my framework, not financial advice. First, I am treating the China offtake story as confirmation that the strategic case for silver has moved beyond investment thesis into geopolitical reality. When the largest industrial nation on Earth is systematically securing future silver supply at the mine level, it validates the fundamental supply-demand argument in a way that no price chart or analyst report can. Second, I am focused on physical silver as the core position. The whole point of understanding the offtake mechanism is that it operates outside the visible financial market. Paper silver, futures, ETFs, these instruments are claims on a market that is being structurally tightened at a level they do not yet reflect. Physical metal held outside the financial system is the purest expression of the thesis. Third, I am watching mining equity geography carefully. The miners who will benefit most from this dynamic are not the ones with Mexican or Chinese jurisdiction exposure. They are the ones producing silver in stable jurisdictions outside China's offtake network: Australia, Canada, the United States. These producers will become strategically valuable to Western industrial buyers who need to source silver without depending on supply chains that run through Chinese-controlled agreements. Fourth, I am monitoring physical premiums relative to spot price as my primary signal for when the paper-to-physical disconnect is beginning. When the cost of acquiring real silver starts meaningfully exceeding the spot price printed on financial terminals, it is the market's way of telling you that the strategic accumulation has begun to bite. And fifth, I am patient. The mistake most investors make when they identify a correct thesis is acting with a timeline that is too compressed. China did not build its rare earth position in a quarter. The copper offtake network took years to fully develop. Silver will play out over a similar horizon. The investors who stay positioned through the noise are the ones who capture the full move. Now I want to hear from you. Were you tracking China's offtake activity before this video? Do you think the Western market will recognize the pattern before it is too late to position? And how are you thinking about your silver exposure, given what you now understand about what China has already done? Drop your thoughts in the comments. I read every single one, and this community's collective intelligence is one of the most valuable signals I track. If this video connected dots you were not seeing before, if it gave you a geopolitical framework for understanding what is happening in the silver market at a level the mainstream is not covering, do me a favor, hit that like button. Share this with someone who is watching silver but does not understand the strategic layer that is playing out behind the price charts. And subscribe to Economic Shadows, because this is the channel that tracks the moves the big players are making before the crowd figures it out. We do not react to headlines. We track the strategic moves. We follow the money. We position before the crowd. When silver reprices, when the offtake agreements become front-page news, when China's corner on the market becomes impossible to ignore, you are going to remember you heard it here first. And more importantly, you are going to be positioned for it. I will see you in the next one. Stay sharp. Follow the strategic signals.